Now let me bring on board Amit Khurana, Head of Equities at Dolat Capital, to talk to us and have a conversation this morning on how he's seeing trends. Amit, great having you. Let me first start off with the earnings trend for Q3. What are you seeing in terms of anything that's standing out? That's point number one. And in terms of the earnings itself, were they ahead of your estimates? Was it largely in line? What's your view?
Sure. Thank you. Thank you for inviting me. I think there were broadly three key trends that we observed for the current quarter. One, earnings held on pretty well in terms of the estimates versus actual delivery. This was after a pretty long time that we saw that evidence playing out. Second, the operating performance has started finding bottoms. Last 3 or 4 quarters, we've seen margin pressures, pretty much across various sectors, stocks. I think this was one of the few quarters where we said that held on pretty well, and it is now forming a base. The expectation from here on will be that the operating leverage plays out on the positive side and accelerates the earning. How far, that we will have to see. And finally, I think we are trending now towards mid-teens aggregate earnings, at least from our coverage universe, which was earlier high single digits. And I think that really is one of the greater confidence building aspects that we go into for Q4 and as we move towards FY27. So positive take on the earnings. And as we go along the next few quarters, I think this will only rebound further and give the much needed confidence and support to the valuations.
And Amit, let me start talking stock specific. And within all of those stocks, you have HUL. The big one, 2,000 crore of capex is what they've announced, obviously expanding their capacities. What do you make of this investment with regard to the quantum? Of course, it's probably very small for the size that HUL is, but what's the intent looking like? And what's the underlying fundamental looking like resulting from this kind of capex that they've announced?
Well, capex from FMCG companies and especially from companies of the size of HUL essentially reflects the structural demand that they are seeing over the next few years. While they have announced a broader sense of how they will spend this money, but I think it will be probably clear over a period of time as to what the focus is. Our sense is this is a reflection of how they see the structural demand. We've seen Nestle also expanding big time on India capacity, and that got completed about a year back. HUL expansion, especially given the size, seems pretty meaningful, and we stay positive on that. Remember, HUL has been sort of trying to premiumize its portfolio positioning over the last so many years, but the competitive intensity has been pretty intense. And therefore, that's been a challenge for them to register volume growth. Hopefully, this expansion that they are doing, especially as it is highlighted in the premium categories, which is exactly what our hypothesis has been, that India is premiumizing fast, and franchises which are able to position their products accordingly will probably have a market share sustenance or gains, so to say.
Now, as a sect, even FMCG stocks have been doing very well, right, of late. Does it look like a sustainable trend, or does it still seem that this is the defensive nature of the market at play?
It's an improved trend. It's a gradual trend for the markets, for the sector. I'm not sure whether now we can draw that link of defensives performing in the zone where, because I think pharma and FMCG, in the heat of the market volatility in the last so many months, we've seen weeks and maybe months of volatility. We've not seen the FMCG and the pharma doing very well for themselves, except for maybe few chunks or few stocks which have actually done very well within the individual pack for FMCG, as well as, if I can probably club in even pharma stocks. But yes, within the FMCG pack, there are a few names which have been very strong. I think Britannia has done reasonably well. Nestle is also the other stock which has done fairly well for itself. And there are emerging names which have shown signs of a breakout. I think if I'm not wrong, yesterday Colgate managed to come out of a swing resistance of almost like 4 or 5 weeks of major consolidation. The stock managed to break past about the 2200 levels. So that could be another stock which can probably try and play a catch up, or maybe some sort of a mean reversion which could be at play. So yeah, the pack looks quite okay on the charts, but I think there are a few stocks which are looking a little bit more better in terms of risk reward.
Kunal, how do you look at Cochin Shipyard as well? It's got another 2,000 crore order. A few days back, we saw it's getting getting a 5,000 crore order for survey vessels. The order book now is almost 6 times the revenues there. How are you looking at Cochin Shipyard?
See, frankly, it's not one of the best performing stock. In fact, if you look at the 2024 highs, Cochin Shipyard was almost at 2,900, 2,850. and from there the stock had fallen down to as much as 1300. So it was not a 50% correction, it was more than that for Cochin Shipyard. And the concern is that the stock, since the 2024 correction, has remained into that kind of a lower price band at current levels of 1450, 1500, where the stock made a swing low. Relatively, when you look at this with respect to, say, Mascot Dock or GRC, etc., that stock has underperformed. So not too much of a bullish chart. It's at current levels below the 50 DMA as well as the 200 moving average. So that tells you that the trend is very weak. The 50 DMA itself is at a 10% divergence below the 200 moving average. So when you try and map this, the stock with respect to the technical parameters, it's still a very weak chart.
You know, the other interesting thing that played out was the FI buying that's happening. You know, out of the last 9 sessions or so, we've seen buying in maybe 7 out of those 9 sessions, which is a crucial positive, at least the way we see it. And in terms of sustainability of that, Amit, if that were to sustain, do you believe that some of the large cap names could well start coming into favor just because of that FII inflow tilt? You could have banks, IT come back, or would you argue against IT, at least at this point, given the AI wave?
Well, yeah, the AI wave, I mean, everybody seems to be talking about it, and given the news flow every day or every week, we keep getting those news which put us a thinking mode as to how far will this sort of impact the growth. And I think market has sort of already derated those stocks. But to your point on the FI buying, I think a lot of that is also tactical, because we've seen FIs being selling India equities for quite some time, and the start of the year sees some fresh allocations coming in. And so part of that is also reflected in these new flows that are coming in. But I'm not very enthused with a few days of buying here or there. I think the concern on India remains, one, the entire mess on the AI wave, and especially even beyond the IT sectors, India has not been able to build any significant presence on the hardware side. So that's been one overhang. And second, the valuations, while they have turned relatively better, are not outright cheap even now. So while one may feel that the Nifty is at sub 20 times FY27 multiples, but when you look at the breakdown of that valuation multiple, there's a very high level of dispersion, and therefore one needs to be stock specific.
So, Amit, anything that you've been recommending buying in this recent drag or fall in the market?
Well, we've been pro-domestic consumption. We've been positive on the select discretionary categories. We also are beginning to like staples, for that matter. So that's been a broader basket that we've been playing out. And the hypothesis remains that rather than look at indices or rather than look at big macro trades, we've been very bottoms up in our approach on stock selection. To the point that we were discussing on FMCG earlier. So we've liked Marico. We believe that the positioning on the D2C space puts them in a pretty good sort of position structurally, and stock's been one of the relatively better performers versus a lever which has been struggling on the volume gains. So this is a market wherein you will have to do a real hard work of identifying the names that you want to go overweight on, and that's been our approach, and that I think continues for the foreseeable quarters ahead. The macro trade is I don't think is coming back as yet. So domestic consumption has been our favorite, and that continues to be the flavor as we go along.
Okay, let's address some of the newsmakers then this morning, and Vitali is here with that list.
Hi, for the stocks in focus today, keep your eyes out on the crude-related stock, as you've seen that the oil prices have surged nearly 4% after the US Vice President indicated that Iran has failed to address the American red lines in the nuclear talks with the President Donald Trump, keeping military actions on the table. Now the spike in the crude will be negative for the oil marketing companies like HPCL, IOCL and BPCL, as the higher input cost, it pressurizes the marketing margins. Also, the crude sensitive sectors like paints, tires and aviation could also see the margin pressure and can be in red today. On the flip side, the upstream producers like ONGC and Oil India might benefit from this spike in the crude prices, as they benefit from the stronger realizations. Moving ahead, keep your focus on Adani Power, NTPC and Coal India, as they may see some positive traction. Now, the sources suggest that the government is likely to offer some significant relief to the mega power projects, including a potential 100% of exemption on the customs and excise duties for the procurement of project equipment. That move could actually materially reduce the capital cost and improve the project viability for these companies specifically. Also, construction major NCC will be in focus today after its arm has received a 2-year debarment order from NHAI, barring it from participating in any further new tenders that are produced by NHAI. And for your information, the total order book as of Q3 for NCC, it stands around at 79,571 crores. Out of this, 22% of this order book is from the transportation segment that includes highways, bridges, and also metros. Moving ahead, Cochin Shipyard will be in focus today on the back of a mega order win. Now, the company has signed a major contract exceeding rupees 2,000 crore with French-based CMA and CGM to design and construct 6 LNG fuel feeder container vessels. Also, watch out for HUL as the company has approved an investment of rupees 2,000 crores over the next 2 years to scale manufacturing capacity in a high-margin beauty and well-being segment, including the home care segments. Lastly, the Clearing Corporation of MCX has scrapped the 3% extra margin on the gold futures and the additional 7% margin on the silver futures, which will be effective today. Now, these additional margins were imposed on February 4th due to the strong price correction that we saw in the gold and silver earlier. That's all.
Okay, thank you so much for that, Mitali. NCC, really stood out for me. Amit, in terms of the order book, it's a sizable order book that NCC already has. And even the book to bill is very, very healthy. But this is large for someone like NCC, where 20-30% of the order book roughly comes from the NHAI directly or comes from projects within that road segment. Do you believe that this could be a huge sentimental negative, and is it an opportunity in your opinion, if at all the stock were to correct or open gap down?
Well, we need to understand what the specifics of the case are. I'm afraid I do not have enough details for me to make a judgment out of it, so I will refrain from commenting. But in general, we found infra stocks have taken a big beating over the last few months, probably because of the slowdown on the NHI order book not being flowing in as much as one would expect. But our channel checks are suggesting that this should eventually play out, and most of these names are now at 5-6 times earnings multiple, and have assets and balance sheet strength to execute. Specific to NCC, we need to wait for the specific details, and this will obviously be contested, and we'll have to see as to how the events play out.
Right. Okay, Amit, hold on to that thought. Let's take a very quick break, come right back, and we'll continue our discussion with both Amit Khurana as well as Kunal Bothra. Used to be a drag, as was Eternal. ONGC as well fell hard, and that was the case with an ICICI Bank, HDFC Bank, which were also flat, and that impacted the index in any case. But Amit, wanted to get your sense in on IT. Convinced yet about the major IT big boys actually signing up with some of the AI giants from the world?
Well, I guess that's exactly what has been the talk of the town. Infosys signing up, TCS making a statement, and of course, analyst meets highlighting what the preparation levels are. I think the market will look for very strong evidence on 2 counts. One, how far is this disruption going to continue? Are we at the end of it? Therefore, the base is formed, and that gives some anchor for one to form an opinion about the earnings trajectory. And secondly, is the kind of opportunities which will come. While there is a fair amount of understanding and appreciation that the productivity gains can play out structurally, but I think the greater concern is on the deflation on the top line that it will have to go through. So once we get the handle on these 2 parts is only when I see these stocks actually being able to re-rate or at least not derate. In the interim, I continue to believe that they will have tactical rallies, they will have sell-offs happening, and they will broadly be in the range. On the supporting side, I mean, most of these stocks are very strong cash flow generating stocks. Most of the free cash flow yields are now trending at 5-6%. So they, in that sense, become a value buy. But I think the market is more concerned about the growth of EPS and the impact of deflation on revenue. I think that will take its own time to evolve, and that's where we are as of now.
Okay, point taken, Amit. Amit, I wonder where you sit with regard to the financials and give us a sense as to whether private banks, PSU banks, the earnings every time continue to surprise where PSU banks are concerned. More required from the private banking side, especially valuations, they've come off now. There's been a bit of a time correction. So how should one look at this space?
Well, we've been more on the private sector banks and especially the small to mid-size because there the balance sheet numbers had strengthened quite a bit. The asset cleanup had happened and therefore there was a considerable amount of scope for them to show that ROA performance, which they did. So City Union Bank is what we liked. Amongst the larger banks, we had a preference from ICICI Bank and Kotak. But I must say that the SBI numbers amongst the PSU pack were extremely strong and pretty surprising. Other PSU, we've been sort of more hands-off approach. So from the PSU, only SBI is what we've liked. And from the large caps, I mentioned ICICI and Kotak, while the overweight preference has been more towards the mid-sized banks. And the NBFCs have gone more to broaden the financial space, so to say.
I also curious to know in regard to EMS. How should one play that? There's plenty of pessimism. The numbers continue to deliver to a certain extent, but valuations, do you believe that they've run ahead of themselves? Have we seen this correction as an opportunity to buy? How should one look at it?
Well, again, that's very stock specific because most of the EMS players are focusing on very specific areas where they're building up capabilities, both in terms of manufacturing as well as technology side. So I would not paint all the names in one color. I think our preference has typically been on Dixon as one of the preferred plays. But the other players are also building up significant capability. And one needs to see as to how will that translate into sustainability of earnings. Remember, most of these stocks operate at very thin margins on the operating side. And sometimes the concern of the market has been that any negative news flow or any negative business development can take away that operating leverage pretty sharply. And there is very little headroom for them to defend those margins. But from the ROE perspective, they remain pretty strong, franchises. So we've been very focused on, our preferred picks there. But I think the greater play you will also see is the impact that they make on widening the revenue base as they go along, rather than only one particular case. And we believe that Dixon has built that up reasonably well.
How do you look at some of the frontline stocks, Reliance for that matter? We've seen good. Stock up nearly 2% in last 1 month there, but from a earnings and from a fundamental point of view, how do you see RIL?
Well, we've liked the stock. I think the only disappointment that we had for the Q3 numbers was a bit on the retail side. And as you go along, I think there will be significant value unlocking opportunities for Reliance for the next 12 to 18 months. That's our base case. There has been some concern around the extent of valuation that Jio will attract, but we believe that give or take a few percentage points here or there, Reliance will be one of the rock solid performers for the next 12 to 18 months, and it is part of our preferred picks universe that we share with the clients.
A couple of approvals that have come through, Amit, overnight with regard to pharma. One is on Dr. Reddy's. They've, in fact, not exactly an approval, but they've acquired trademarks from Mercury Pharma for around 350 crore rupees INR, marking its strategic entry into hormone replacement therapy segment. So that was one. Aurobindo Pharma yesterday got notified of on certain non-compliances with regard to their factory. And then you had something like a Zydus Life, which got approval for its PAH drug in the US. All three of those likely in focus. Do you believe pharma? How do you sit and how would you tilt yourself in terms of the portfolio within the pharma basket?
Well, we've been neutral on pharma. I think that was one trade which made a lot of returns for the investors, FY24 and good part of 25. But I think 26 has been more of a consolidation year for them because the impact of one-off launches which led to earnings trajectory being on the positive side actually normalized. And I think over the next couple of quarters, we'll still see that Revlimid, normalizing, and largely you are seeing volume uptrend for domestic markets pretty well. But the one-off launches pipeline has been fairly dry. Our sense is that second half of FY27 will show you some visibility, and that's exactly what we are waiting to see unfold. From a preference perspective, we've been liking more on the mid-sized pharma names, which are more domestic oriented and have a much better product portfolio, so to say. That's what we've been liking. We particularly like Ajanta, considering it's done reasonably well, and their overseas business will also rebound pretty well. So that's been one name that we have been backing up.
Okay, interesting. Amit, great to have you today on the show. Thank you so much for your time.
Thank you.
Okay, let me bring on board Rabinder and highlight some of the other newsmakers this morning. Rabinder, what are you picking up?
Well, it's lots of pharma stock can be in focus in today's trading session. Firstly, let's start with Dr. Reddy, where Dr. Reddy can be in focus. The company has entered into a definitive agreement with UK-based Mercury Pharma